Welcome back. We are diving straight into what has to be one of the most confusing market reactions we've seen this quarter.
Yeah, we're talking about J.Jill Inc., ticker JLL. They had their Q3 fiscal 2025 earnings call on December 10th, pre-market, and the aftermath was, well, something else.
Puzzling is an understatement. So our mission here is to really untangle this major market paradox.
Exactly. Because J.Jill beat expectations. I mean, on both the top and the bottom lines, a really strong numerical performance.
And yet the stock just plummeted, double digits on heavy volume.
It's a classic case of the market completely rejecting the backward-looking numbers and pricing in some terrifying forward-looking risk.
That's the hook right there.
Yeah.
How does a company deliver what they called a better-than-expected Q3 only to have the tape just vote so violently against its future? We have to look past that beat.
We absolutely do. We have to understand the guidance that spooked everyone. But first, let's just quickly look in that rearview mirror. Q3 operationally was sharp.
It really was. Revenue came in at $150.5 million.
Which topped consensus by over $2 million. But the real story, was the profitability. Adjusted EPS landed at 76 cents.
76 cents.
Already.
And the street was looking for 59. That's a 17-cent beat. I mean, that almost always triggers a rally, not a rout.
Right. It sounds like a company that's managing its costs really well in a tough environment.
So what did the actual demand picture look like inside of that strong number?
Well, that's where you start to see the cracks. It was already a bit of a mixed picture. Total comparable sales were slightly negative, down just under 1% at minus 0.9.
But the digital side held up.
It did. And that's crucial. Direct-to-consumer, their DTC sales were actually positive, up 2%. And that channel now represents almost 47% of their total sales.
Okay, so maybe fewer people walking into stores, but they were still clicking buy online.
Yeah, and management also pointed to really disciplined promotion management. That helped them keep their gross margin pretty robust at 70.9% for the quarter.
So they were winning the internal battle in Q3. But then they opened the hood on Q4. And I guess the engine was on fire.
That's a good way to put it. The stock dropped 13.5% almost immediately on volume that was over 3.5 times the average.
The market was basically screaming that the Q3 execution was totally irrelevant compared to the impending Q4 disaster.
And what's fascinating is how sudden the shift was. Management was very open about a softer start to Q4. They pointed to one core problem.
The promotions.
Exactly. The competitive market became, and I'm quoting here, very promotional, very early. They said it started in the first half of October. That intensity just immediately exposed how price-sensitive their customer is right now.
And that's a tough combination on its own. Intense competition forcing discounts. But they also had these mandatory cost headwinds hitting at the exact same time.
And that's what created the profitability cliff everyone's talking about. You have to understand the tariffs.
Right. In Q3, they only felt the initial pressure.
The initial pressure, yeah, about $2.5 million in net tariffs. But because of how inventory accounting works, the full impact, that's about $5 million in net tariffs, was slated to hit their cost of goods sold in Q4.
Okay, so let me get this straight. The pain they absorbed in Q3 was only half of what they're forced to swallow in Q4. And on top of that inflated cost base, they have to layer on deep promotional discounts just to move product. That is absolutely lethal for margins.
It is a literal crunch. And the Q4 guidance showed it. They're forecasting net sales to be down 5 to 7% year over year.
And comps are even worse.
Yeah. Comparable sales falling even further, somewhere between 6.5% and 8.5%. But the number that really caused the panic selling was the adjusted EBITDA forecast.
Okay, let's put this in stark relief for everyone listening.
They just delivered $24.3 million in Q3 adjusted EBITDA.
A very healthy number.
A very healthy number. For Q4, they expect that to plummet to the $3 to $5 million range.
$3 to $5 million. That's a staggering collapse. I mean, that's almost 90% of their profit just wiped out from one quarter to the next.
It reflects the full $5 million tariff hit, plus all that gross margin pressure from the promotions they have to run.
That level of profit sacrifice isn't just a slowdown. That's a company slamming on the brakes so hard they risk going through the windshield. Why take that big of a hit right before the holidays?
It's pure damage control, but with an eye on the future. Management explicitly said the goal is to manage through this Q4 so they can enter Q1 of 2026 clean.
So they're taking the entire financial hit now.
The whole thing. clear out the inventory at whatever margin they can get, just to set up a better starting point for next year instead of dragging overpriced, unwanted product into 2026.
Which makes that inventory number a sacrifice play. I saw they reported inventory was up 8.4% year over year, which, at first glance looks bad.
Right, but there's context there. The CFO clarified that if you exclude the roughly $6 million in higher tariff costs that are baked into that valuation,
the actual volume of inventory was down 1%.
Exactly. They're clearing the decks now, even if it completely torches this quarter's profitability.
So if they're willing to sacrifice Q4 to clear the slate, it means they are betting everything on next year's strategic rebuild. What does that long-term plan actually look like?
That's the pivot, right? We have to move from the Q4 bloodbath to the 2026 recovery narrative. Management laid out 3 key strategic pillars.
Right. Assortment evolution, enhancing the customer journey, and operating effectiveness. This is the foundation they're trying to build, and it's why the market needs to look beyond the next 3 months.
And that first pillar, assortment evolution, seems to be driven by some really keen customer insight. Management noted that their customer is being very choiceful.
Meaning
they're passing on the simple stuff like wardrobe updates, your core replenishment items, but they're responding extremely well to anything that's genuinely new and novel.
And we saw some evidence of that working in Q3, didn't we?
We did. They cited strength in core categories, your bottoms and jackets, outerwear, but the real green shoots were in their newness tests, things like faux leather and suede.
And I think I saw small capsules of cashmere, sleepwear, and travel sets.
Yes, and those showed strong full-price results. That's the critical part.
Right. Full price sell-through in this environment validates their whole product shift.
It absolutely does. So their strategy for 2026 is to actively move the whole assortment to prioritize this newness. And they can start to really influence that in the back half of Q1 next year. It's a move away from relying on predictable basics to driving demand with actual fashion.
They're also getting smarter about where and how they sell. That customer journey pillar. I find the localized testing really promising.
Like the New York store pilot.
Exactly. Tailoring the assortment, more black, less print, to suit local tastes, and really focusing on how outfits are presented in the stores.
And that localization extends to their marketing, too. They're right-sizing their catalog circulation, which is smart. Only sending those expensive mailers to people who actually buy from them.
While reinvesting those savings into digital prospecting.
They ran a national TV and streaming pilot and a big digital social ad push in the Chicago market. It's all about learning, testing, and figuring out how to expand their reach efficiently, which feeds right into that new hire.
The organizational move. The creation of a new chief growth officer. That signals a massive shift toward modernization in tech. To me, it feels like the centerpiece of that whole operating effectiveness pillar.
It truly is. This new role is explicitly tasked with leading e-commerce and, most importantly, advancing their AI initiatives and driving the longer-term tech roadmap. This isn't just hiring a new marketing head.
No, it's a strategic pivot.
Yeah.
So what does this AI mandate actually mean for a retailer like J.Jill?
Well, they're building on foundational system work they did last year to get their data cleaner. Now they can actually use it. They want to use AI to drive operational efficiencies.
So think like algorithmic inventory forecasting.
Exactly. Which directly addresses the problem they're having in Q4. It minimizes future inventory risk. But also personalized merchandising, better customer acquisition on the digital side, even optimizing the timing and content of those catalog drops.
The goal is just faster testing, better resource allocation across the entire business.
Yeah. And despite the Q4 margin devastation, their financial discipline is still remarkably strong.
Right. They generated almost $16 million in free cash flow in the quarter.
And they're still committed to returning cash to shareholders. They kept their dividend at 8 cents per share. That strong cash flow is a critical backstop against all this volatility.
If we connect this to the bigger picture, the market's extreme reaction makes a bit more sense. J.Jill had already pulled its full-year guidance earlier in the year.
Right. Back in June, due to macro uncertainty and a leadership transition. So this Q4 guidance cut hit a market that was already extremely skittish. Investors hate uncertainty above all else.
And the competitive environment really highlights that this is a J.Jill specific issue, not just a retail sector problem.
Oh, absolutely. If you look at J.Jill's total return, it was down over 48% in the last year.
Wow.
In contrast, Benchmarks like the consumer discretionary ETF, XLY, and the broader retail ETF, XRT, were posting positive returns over that same period.
So that tells you loud and clear.
Yeah.
This isn't the whole sector dragging them down. This is a specific J.Jill execution and guidance problem that is being aggressively priced in.
Which raises the big question. What are the specific measurable checkpoints the market needs to see before that stock price can even begin to recover?
We've kind of identified 3 clear catalysts that investors are going to be watching over the next few quarters. First, obviously, is the stabilization of Q4 performance against that very aggressive guidance. Did the sales decline end up closer to -5%, or did it really hit the bottom end at -7%?
Second, they need to prove their pricing strategy can work. It was successful in Q3 in raising their average unit retail. Can it continue to offset these tariff impacts without completely eroding their brand's value perception in a hugely promotional market?
Right. They need to show they can compete without just liquidating everything.
And the third catalyst isn't just about strategy, it's about measurable results. The market needs to see concrete evidence that the AI and tech modernization, driven by that new chief growth officer, is actually driving quantifiable improvements.
Like better digital conversion rates or a measurably better cost for acquiring a new customer in 2026.
Exactly. That proof of concept for their foundation building phase is what will unlock the stock's long-term value.
Which brings us to the segment we call This is Not Financial Advice. We've established the extreme negativity baked into the stock price following that Q4 guidance, $3 to $5 million in adjusted EBITDA. I mean, that really looks like the absolute financial trough.
It does. Every single known headwind, tariffs, promotions, it was all crammed into this one quarter. The floor has been set extremely low.
Exactly. So here is the outrageous but plausible pitch for the experienced high-risk investor. A long Jill volatility. Short XRT momentum play.
A bet on extreme divergence. Okay, explain the thinking behind this high-level trade.
Well, the trade is based on the belief that Jill's Q4 guidance has already captured the absolute worst-case scenario. If, and it's a big if, but if management succeeds in entering Q1 2026 clean, as they plan,
then any tangible early positive result could trigger a massive relief rally.
Precisely. Say the new leadership shows some quick wins in digital prospecting. Or they announce a Q1 growth margin outlook that is dramatically higher than Q4's.
Because the baseline is so disastrously low, any marginal positive data point looks exponential compared to what the market is expecting.
You got it. You're betting on the magnitude of the snapback recovery from the trough relative to the broader retail sector, XRT, which is trading much higher. You're betting that the organizational pivot, the new focus on AI, better assortment, a leaner cost structure, provides leverage that the market is completely ignoring right now.
It's a classic low-float, high-risk bet on a swift reversal in sentiment once we start to get some color on Q1 2026.
And again, this is for illustrative purposes only. This is not financial advice.
So to summarize our deep dive here, the core tension with J.Jill is crystal clear. Q3 execution was commendable, they beat on EPS and revenue. But Q4 visibility is highly obscured by intense promotions and the full crushing force of those tariff costs. And the stock is aggressively discounting that near-term pain.
The question we really want to leave you with is this. Given management's very strong emphasis on bringing in a new chief growth officer, on launching explicit AI initiatives and a technology roadmap, this is an aggressive pivot toward efficiency. Is the stock's current discount an overreaction that ignores the significant potential leverage they could get from becoming a much leaner, more technologically savvy retailer in 2026?
Is the short-term pain required to build that foundation actually worth the long-term benefit? And has the market priced in none of that future technology-driven efficiency? That's what you need to explore.
We look forward to following the ongoing story of J.Jill's strategic rebuild with you next quarter.